Capital structure and dividend policy. The capital structure is the firm's mix of financing. I gave an example of this earlier with Mobil Oil. Companies often review their situation and decide to change their capital structure without changing their assets. Indeed, in the difficult current financial climate, companies are often looking to restructure their debt. This may involve getting agreement from other organisations to whom they may have currently been in a position where they owe money, to pay them back over an extended period of time. This has two advantages. One, it buys time to implement new business strategies, and two, it allows a retention of a far healthier cash flow situation within the business over the short term. Such a decision is likely to be made in the expectation of an upturn in the economy and or the company's fortunes in the longer term. It should be noted that there are always potential risks to shareholders if the company does decide to utilise debt. For example, if the company is currently in debt yet decides to take on further borrowing. Recently, the company EMI, which is famous for producing and owning music, such as music by the Beatles, was taken over by the banking organisation that it had used as the owner of the company. Guy Hands could no longer pay the interest charges per month that were outstanding on the loan that it had agreed with the bank in the first instance. Now, this bank is Citigroup, quite a large international bank, and so that bank now owns this music business and is looking to sell off the company. I understand it's in talk with Sony, with Bertelsmann in Germany, and Warner in the United States in a bid to sell off the business it is now taken ownership of through default by the Guy Hands company no longer being able to pay the interest on the loan they had borrowed. So there is always the risk and the cost of failure or indeed bankruptcy. So when choosing to invest in an organisation, it should be remembered that some companies traditionally pay a high share dividend, whilst others only pay a low share dividend. Again, traditionally the multinational companies such as Unilever and Procter & Gamble only tend to pay a medium share dividend. This is due to the fact that they are seen generally as being safe stock, a safe investment. However, pharmaceutical companies do tend to be much more variable or inconsistent in their share dividend payouts. This may be due to their operations being much more volatile, in much more volatile markets, and so will be based upon their financial performance each year. Confidence can be gained from reviewing earnings records over time. A good example of this is the company Nike, where you can see their EPS or earnings per share over the past 15 years, which has tended to be highly impressive. There are many measures that can be taken to help identify a company's current financial position, such as the balance sheet, which I mentioned earlier, and then the use of financial ratios. These are extremely helpful in measuring performance of a company, and there are several different types of ratio that can be used. There are leverage ratios, liquidity ratios, efficiency ratios, profitability ratios, and market value ratios. Then there needs to be financial planning. There does need indeed to be good financial planning, and good organisations are essentially aspects of investing successfully. There are three requirements for effective financial planning. They are: 1, forecasting, providing your best forecast bearing in mind your competition. 2, choosing the optimum financial plan. And so you should generate several alternative plans and then select the one that seems, in your opinion, to be the best of them. And then 3, watching the plan unfold. Here you need to remember that as soon as your plan is written, it is in fact out of date, so you need to keep updating it, you need to keep revising it. This financial plan does involve a number of things. One is inputs, such as forecasts of key variables. 2, planning models, use equations to help specify key relationships that may occur. And 3, outputs, the use of financial ratios and any projected financial statements and the source of funds and the uses of those funds. Now we need to look at working capital, short-term planning and long-term planning. The definition of working capital is this: current assets minus current liabilities. This money is the lifeblood of an organisation, as it is necessary to allow the business to function on a day-by-day basis. It must bear in mind that there is a time difference between paying for materials and later on collecting payments after sales of products have been made. A company does need to look both long-term as well as short-term when planning its finances, so it must match maturities. Financial short-term assets such as inventories and accounts receivable by short-term bank loans or by issuing short-term debt, and financial long-term assets such as plant, machinery, and by long-term borrowing and equity. Then 2, permanent working capital requirements. Again, this essential working capital requirement should be funded by long-term sources of funding. And 3, the comforts of surplus cash. Many companies prefer to operate with a surplus of cash. Historically, companies such as General Motors and Marconi did this. However, other companies believe that to satisfy their shareholders, even this money should be put to work, either by investing further in their own company, or indeed, perhaps, by investing in another organisation, even a competitor. Examples of short-term finance may include bank loans through a line of credit, which is an agreement by the bank that a company may borrow at any time and up to an established credit limit. 2, commercial paper, short-term unsecured loans. These can be for up to 9 months, but are usually paid back in 2 months. And then 3, secured loans, where company assets are often used as security. Again, this may involve a bank. And then there is number 4, factoring. This is where money can be raised quickly from use of a factoring agent. They will take ownership of your outstanding invoices. They will pay you a percentage of those, for example 90% of the total owed, and then they will seek payment of the full amount outstanding over a period of time, and this money will then be for themselves. Examples of long-term loans or financing will include mortgages and debentures. Now we need to move on to high-risk strategies. Logically, the higher the risk of failure, then the greater the return on your investment if it is successful. One way for an organisation to grow is through an agreed merger, where it simply merges with another organisation. This obviously increases its size and may also increase its market power, particularly if both organisations operate in the same or similar markets. A similar strategy can be applied to the use of acquisition, where one company buys another company. This may occur through agreement, where one of the companies wishes to be bought and the price of purchase is acceptable to those who own the company. However, very often the company being sought does not want to sell or believe that the price offered is insufficient. Then, if they are a PLC, the other company, the organisation, commences buying their shares in the market in what is in effect going to be known as a hostile takeover. For the investor, the question is this: whether it is a merger or acquisition, will this create shareholder value? Will the value of the shares increase? And if so, will this increase be maintained over time? However, experience over time tends to show that when the two companies do combine, there will be an initial benefit of cost savings. These tend to occur due to the recognition of the need to strip out any duplication that will now exist. However, this tends to be fairly immediate, and once completed, cannot be replicated. Some acquisitions do prove themselves to be worthwhile, but only over an extended period of time. So they will benefit the long-term investor who does remain patient. For example, the American drug company SmithKline bought the UK company Beecher. Later, the UK drug company Glaxo purchased SmithKline Beecher to become GlaxoSmithKline. This combined organisation with shared research and development is now one of the largest pharmaceutical companies in the world. So the benefits of two companies combining may include the following: economies of scale, economies of vertical integration, the combining of complementary resources, and the utilisation of surplus cash. However, more often than not, the combined organisation fails to deliver the expected financial benefits. One example is the company ITV, who bought the friendsreunited.com website for a very high price. But this was unsuccessful and was recently sold at a vastly lower price than they bought it for. Another example is the company News Corp, who bought the MySpace website. Again, the price was high. They bought at the top end of the market. Again, it did not expand as required, as expected, and so has now been sold off at a low price. In each case, the shareholder value has been eroded. Recently, the security company G4S has announced that it will not now take over the Danish cleaning company ISS due to opposition from its own shareholders. The cost of takeover was due to be £5.2 billion sterling. Their statement now says it will be inappropriate to proceed with this takeover. The shareholders were particularly concerned over the takeover strategy that was to be employed and the size of the rights issue. The combined group revenues, if the takeover had taken place, were estimated to have exceeded £16 billion sterling. One of the main negative reasons for two or more organisations joining together is diversification. This is where the purchasing company wants to expand into other markets than those its company are currently satisfying. Clearly, this sounds to be a good strategy. However, what often occurs in reality is that they have strayed into areas which they are unfamiliar with, areas which they know very little about. Often they go on to make wrong market decisions, they begin to flounder, and the competitors in this market, or these new markets, will benefit from this. So, how can mergers and acquisitions be evaluated? By two methods. One, is there an overall economic gain to the merger or the acquisition? And two, do the terms and conditions of the merger or acquisition make the organisation and its shareholders better off or not in the short term or indeed in the longer term? These mergers and acquisitions can be financed either by cash or by stock or by a combination of the two.